Good morning, good afternoon, good evening, students. Welcome to my channel. Mr. McRitchie, BNHS here, to show you one more thing for AP Macroeconomics. A very sort of random graph, the business cycle. This is a graph that fits under sort of the umbrella of things like the circular flow model, which is a visual aid you should know. They might reference on the AP exam. You probably won't ever have to draw this thing. I would be very surprised if they ask you to draw it. So it's not under that umbrella of like 6 graphs you have to be able to draw and manipulate, like your production possibilities curves and your supply and demand graphs and your aggregate supply and demand graphs, which we'll get to in the following unit. But it's a visual you need to be aware of and will become very helpful in sort of visualizing things from this and next unit. Things like full employment, as well as what full employment actually means in our real economy, because like using all your resources, is that a real possible thing, or using most of your resources, is that good enough? Stuff like that. So we'll hit on all of that today. Not sure why my song of the day isn't popping up. I'll just tell you what it is. It's Reptilia by The Strokes. The Strokes are awesome. Rock music is dope. Okay, so with that being said, to the video, the business cycle. Okay, business cycle is a very, very, very basic visual. It looks like this, actually. It's a wavelength looking graph. Now, as sort of a brief overview, my camera is in the way. I'm moving that over there. It is a model that shows how output changes over time. GDP, basically. It's like, hey, here's your economy's production over time. It goes up and down. You would assume it goes up continuously because of things like population growth and how technology improves over time. But there are periods of time where it dips. It's sort of this life cycle of an economy where it has its ups and downs. It shows your periods of economic growth, those goal points we're always looking for, that are referred to as expansion periods or inflationary periods, periods where there's a lot more expanding, and usually to coincide with that expansion is the rising of prices, because when your economy is growing, people are spending more, prices will rise along with it. It also shows periods of decline, these sort of downturns of the wavelength, that are recessions and, in worst case scenario, an economic depression. Okay? It's also a good model to show some stuff with Unit 2's natural rate of unemployment from the previous video if you watch them in sequence. The natural rate of unemployment and the non-accelerating inflationary rate of unemployment, NIRU. Those two things are kind of visualized with this as well. Oh, spoiler, this will be a fairly short video because this is a fairly short concept. It's like if I did an entire video on just the circular flow model. So, some vocab. I like how there's pink on the screen. It just completely messes up and makes me look like I'm red. Oliver. That kind of offsets it. So, a recession. This is big vocab. Huge for next unit, for Unit 3, but good to know now because, I mean, we're in one. It's a period of declining economic activity. Technically speaking, it's a period of time in which there's a decline in your real GDP. You're producing less. That can mean a lot of things functionally for your economy in terms of you have a decrease in income, you'll have an increase in an unemployment rate, you'll see reduced inflation because there's less spending, so it's good for that. Although it can cause deflation if going too far, and I mentioned in a previous video how deflation is not super good. The basic idea of how these happen, and they can happen for a litany of reasons, but here's sort of just your basic reasoning. If there's a large enough scale event that reduces spending and productivity by a large enough amount, it can trigger a recession. Previous examples of this prior to COVID would be things like the dot-com crash back in the early 2000s, where people were buying up a lot of just website names like food.com, expecting that to be like very profitable because who doesn't buy food, right? It's like, yeah, but food isn't a brand, it's just a thing, so congratulations, no one owns the concept of food. People had been spending a bunch of money on that, which turned out to be incredibly invaluable, so they had a large reduction in their income, or at least spendable money that they could spend on things that actually require productivity. Making up a domain name doesn't require any productivity, so it caused a quick, it wasn't a massive one, but it was a recession. 2008/9's housing market crash. Not going to explain that entire thing to you. There's a whole bunch going on there. If you want to watch The Big Short, it's a 2.5-hour movie that does an actually pretty decent job of explaining it while being entertaining. But basically, housing market had a massive bubble and collapsed. That's really bad. In present day, obviously, the pandemic with COVID has caused one. That's very easy to understand because like people don't have jobs or can't work because it's not safe. And cool, if you can't work, you don't have money, can't spend it, bing, bang, boom, recession. That's an easy one to cause. So yeah, global pandemic is a fairly easy recession to predict. Of like, oh yeah, this is going to mess things up real bad. Oh, I scaled too many times. All right, so here is the business cycle visualized. The y-axis, you might see a few different things here. It is always some version of output or total production. It could be it just said as real output. If you ever see the words real output, they just mean real GDP. It's just the like non-specific version of that, where it's like a more generalized thing. Like, you might not want to use GDP for your specific thing, but it's some similar metric that measures overall production. You could use per capita GDP here as well. You could use nominal GDP, frankly. It'll still show the same general pattern. The nominal one just looks a little more positive because of all the inflation. Generally speaking, the time axis is always time. Different variations of what amount of time we're talking about. Usually it's in quarters, so 3 months. Quarters of a year is how it's working out. So here's the visual. We've got this wavelength, which is just telling us that over time our economy experiences up and downs. It's on an upward trajectory because the general pathway of our economy is overall upward. Like the recession we're in now is still, like, from a raw numeric standpoint, our economy is like still doing better today than it was doing like 30 years ago. That'd just be because the trough today is higher than the normal spot 30 years ago. Doesn't mean we're actually like, crushing it. It's just relative speaking. So we have these ups and these downs, and we're generally following a positive trend line. That trend line is often referred to as full employment. The idea being that if you're at this line, like right about here, even here, 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 your economy is kind of at its like maximum capacity. We mentioned that with like the production possibilities curve of being on the curve. Hitting right along the trend line is the same as being on the curve. Now, it could be good or bad. You could be on the trend line during an upward sloping period where your economy is growing. So it's like, cool, we have hit the good point. Now we're going to start to taper off a little bit because we're hitting full employment, which means from here on out, any extra productivity we're doing is in sort of the unsustainable category. The idea that full employment is your maximum sustainable level of output. Like you can hold steady there for a while. We tend not to because of profit. We tend not to because you're like, cool, I'm making more money. I want to make more money. It's like, well, okay, but we're already at capacity. It's like, no, but I want more money. So tends to go a little bit too far, which causes it to taper off, usually into what are inflationary periods of time, which will then, when things get a little bit too hairy, like spending in markets that you shouldn't be spending in, housing market, .com market, etc., GameStop occasionally, okay, it'll drop down into a recessionary period. And this is for an economy as a whole, where your GDP is growing. Now, in the real world, your business cycle isn't going to be as like clean of a wavelength as this. There are time periods where there's a lot of up and then a little down. There are time periods like right now where there had been a lot of up and there's now a lot of down. So we've got a fairly severe up and down cycle for this last sort of, if we're going to emphasize like shape part, for like the last chunk of hours that we've had right now. It's a pretty severe one historically because our economy had been growing so well the last 8 years or so, and then COVID. Now, sort of phases of the business cycle, words to be aware of: expansionary and recessionary periods, these upward and downward sloping things. During the expansionary periods, even when it's below full employment, even when it's down here, you're seeing output and employment increase, meaning unemployment dropping. People are working more, making more money, spending more money, having more jobs. So in the upward sloping time periods, you're seeing these expansionary periods. Now, that's a generalization. In the real world, there are obviously complicating factors of this, of like, well, like if you have an insane amount of wealth, we're talking the millionaire, billionaire group, you can kind of spend a lot theoretically whenever. They don't. They're usually pretty savvy when it comes to spending, but they can kind of spend whenever, which can sort of drive expansionary periods, even when sort of your middle class to lower class people aren't spending as much. So like say middle class spending is like not changing, or maybe even just a little bit less than before. If your upper class is spending like crazy, it's going to feel like an expansionary period, even though a lot of people in your economy aren't really experiencing that. So that's like a real world versus the graph problem. But the graph itself is just saying, hey, in these expansionary periods, there's at least output production is going up, which means there's usually more spending that's happening. And employment should be rising because as businesses are making more money off that spending, they can hire more people and cycle continues. During recessionary periods, you're seeing output fall. Again, I mentioned that recessions are periods of time where GDP is dropping and employment is decreasing, meaning unemployment is rising. Those are your sort of big things. Your turning points are the peak and the trough. And I know it's spelled tro, it's trough. English is a hard language. It's basically when output just switches from increasing to decreasing, from decreasing to increasing. Generally speaking, peaks are more sudden, troughs are more gradual. Because usually a peak happens with an event. A crash of a market is usually what's been happening for a while when it comes to recessions. Has been a market crashing of some type. Pandemic is a separate example, but same thing there for America of like spring break time 2020, we hit the peak, or right before that, basically February, I think. We were sort of hit the peak of it where it's like, wait a minute, should we be getting safer for COVID? And Rudy Gobert tests positive in the NBA. Everyone starts shutting down everything, and tailspin. Troughs usually are more deliberate because getting out of a recession is usually a more gradual thing than getting into one. It's usually a couple changes in policy. It's a change to taxes or government spending that needs to be done to try and sort of get us out of it. You can imagine that'll be the same case for COVID. Like over this year, we should see a gradual sort of mellowing out of the trough as vaccines get distributed and jobs can go back to quote unquote normal. In that case, then yeah, it's gonna be like the trough will be like a full like 2, 3, 4 quarters of it being kind of in this like it's not going down, it's not really going up yet, and okay, everyone's got the vaccine, okay, and we're back up, going back up, right? So be careful for that. Peak's quick. Peak like that was like a 1 month thing where it's like whoop, and we're going down. Troughs take time. Now, probably the most important thing to understand with this graph when it comes to other things in the course are the ideas of actual versus potential output. So, actual output is the level of production your economy is currently producing. It's your spot on the wavelength. Wherever you are on the wavelength is your actual output. So if I'm down here around the trough, I'm experiencing what's called a negative output gap. I am in the part of the graph where my production is below, air quotes, where it should be. Because that full employment line is sort of like your idea of efficiency. It's a good indicator of where your economy should be. If your economy was improving at a consistent, stable, sustainable level, you would be at this amount. If I'm below that line, we're producing less than we should be, so we're in a negative output gap. So potential output, this line, potential GDP, that full employment line, is how much your economy would be producing if you were at full employment. And I mentioned in the previous video, full employment for us means producing at the NRU, your natural rate of unemployment, the ideal amount of unemployment for your country, which usually for America is between 4 and 5% unemployment. If you're at that number, you're probably pretty close to full employment. You get lower than that number, say you have unemployment of 3%, then you're actually above it, which feels good. We'll get to that, why that's bad in a second. If you have more unemployment than that 4 to 5% range, say you have like 7%, or like President's Day where we have a lot more than that, you'd be in the negative output gap zone. So the idea is, if I'm having negative output gap, I'm producing less than I should be because my output level, GDP, is negative, less than what it's supposed to be. Positive output gap means that my output level is higher than what it's supposed to be. Now, why that's bad? So when they're not the same, you have an output gap. Here's another graph where it's a little simpler visualized. That potential GDP is your trend line of real GDP, how far it looks like it should be going based on the wavelengths pattern. A positive output gap, this is the like most mathy version of it, is when your current level of output exceeds potential output, when your unemployment rate is less than the natural rate of unemployment. So if unemployment rate is less than what it's supposed to be, meaning I have more people working than I should, I'm going to have a positive level of output. You have what is effectively overemployment. Now, from yesterday's, or I say yesterday, but like my class yesterday, from the last video, which was over unemployment, why that's bad. If your unemployment rate is less than the natural rate, what that means is that you're employing more people than you theoretically should be. You have removed some of the good versions of unemployment from your economy. You have less structural or less frictional unemployment. Unemployment rates that we should be having. Maybe you have keeping some jobs around that shouldn't necessarily be kept around. Some businesses that should have gone out of business are no longer going out of business. okay, which is like good from like you want businesses to like be able to keep people employed and stuff, but some industries should stop existing. Coal is not an efficient natural resource. It gets burned up very quickly, it's used very easily, and it doesn't replenish itself very quickly either. Like, it's not an efficient resource. Solar energy is a lot easier. Science is harder, but the sun is there. The sun is already there relatively easily. So things like that, you want to talk about like which industries should be going away and stuff like that. Coal is a good example of one that like time-wise, we don't need to be using the same resource we were using back in 1450 whatever. So that's also called an inflationary gap because the common negative externality to that, the common problem of being in a positive output gap is that you have more people working than you should be, which means more people are spending than what they should be, which I know feels, like people want to be spending money. It's like, yes, but as an overall economy, if everyone's spending too much, it drives up prices. So you get this low unemployment, so higher income, which, yay, but creates an issue, inflation. It's always a downside and an upside in economics. The downside to higher income is higher prices, because businesses catch on. A negative output gap, in this part right here in the red, is when you're producing less than you should be, meaning your unemployment rate is higher than what it's supposed to be. It's called a recessionary gap because if you're in that part of the graph, you're in a recession, generally speaking. Now, you can be recovering from recession and still be in a recession. Like, think of being sick and how you still have the flu, but you're feeling better than you were 2 days ago. It's like, cool, you're on the upswing. I would still not want to hang out with you if you had the flu, but we're feeling better. But you're feeling better, which is good. So out in that negative output gap, you are still in a recession. Your GDP is lower than what it's supposed to be. Right? That's what that line is what your GDP is supposed to be. Cool, it's less than that. Oh, recession. Got it. Now, when you're in this upswing part, you might not be necessarily labeled as a recession, depending on who you ask, because technical definition of recession is a decrease in real GDP. And if you're, going up, then your GDP is rising. But from like a how is our economy doing standpoint, being below that line means we're producing less than what we should be producing based on our current levels of resources. So it's still overall like not good to be below the line. And that's it. That's the whole business cycle thing. There is not more to this graph than that. This graph will be correlated with a thing in my next unit. So if you've already watched that and you're watching this one later, fine. But if you haven't, get ready. Because the aggregate demand, aggregate supply graph, specifically with the long-run aggregate supply curve, is going to be based a lot off the logic of what this graph is. So if you get this graph, fantastic. Whenever I'm referencing things with like the long-run aggregate supply curve and how that's showing us recessions versus inflationary periods, think of this graph sort of as like a side-by-side parallel of like, oh, so like this on this aggregate demand side thing is the same as this on the business cycle thing that I did understand. Yes, so this is a shorter video, but it pretty much nails it in terms of giving you the most simple version of how the business cycle works. Business cycle ultimately is not that difficult of a concept. It's not one that's meant to try and scare you or confuse you. It's more to introduce you to the idea of how our production looks in the real world over a longer period of time, over the long run, which is a phrase you're going to become aggressively familiar with in the next unit and learn to hate, because it's the hardest part of the course, basically. But this graph hopefully gives you a nice, simple version of how it works. So again, the big idea of the graph is production over time, wavelength. There is a general trend line of that, which is what your production should really be. It's sort of like your full employment amount. You should be on this. If you're above it, you're probably experiencing some inflation. You're probably overemploying people. If you're below it, you're experiencing a recession and probably have too much unemployment. So it's sort of like a quick little like health gauge of how your economy is doing. Are we on the upswing or the downswing? Are we above or below full employment? It's a good little way to think about it. Okay, but that is it for today's video. If you have any questions, of course, leave them in the comments. I'll try to respond to them best I can. And I'll bring stuff like this back up when we talk about aggregate demand, aggregate supply in the long run and as well as in the short run. Cool. Thank you guys very much. Have a great rest of your day.